Something does not add up. JP Morgan just took delivery of another 8 contracts of physical silver. Bank of America stopped 26 contracts yesterday. Wells Fargo stopped 9. Morgan Stanley stopped 4. Every single day, the biggest banks on the planet are signing delivery notices for physical silver at $84 per ounce. And while they are loading up on physical metal, the paper price of silver is stuck below $90, rejected, capped, held down. Why would the most powerful financial institutions in the world be aggressively accumulating physical silver while the price is being suppressed? That is the question I am going to answer in this video, because what I am about to show you is not speculation, it is not theory, it is not opinion. It is COMEX delivery data, official records, names, numbers, contracts, dates, the receipts. And when you see what JP Morgan, Bank of America, and the other major banks have been doing over the past 9 days, you will understand exactly why I believe silver is about to make a move that will shock the entire market. Welcome to Finance Currency. Hit that subscribe button right now, because what you are about to learn is something you will not find anywhere else. Before we dive in, I want to ask you something. Drop a comment right now and tell me what time it is where you are watching this video. And tell me which country or city you are watching from. I want to see how global this audience is. I want to see if you are watching at 2 a.m. because you cannot sleep thinking about silver, or if you are watching at lunch break, or if you are watching on your commute. Drop that comment, time and location. I read every single one. Now let me show you what the banks are doing. Pull up the COMEX Silver Futures delivery data from March 2026. Here's what the numbers say. In just 9 days, 6,680 contracts have been issued for physical delivery in March. Each contract represents 5,000 ounces of silver. Do the math. 6,680 contracts times 5,000 ounces equals 33.4 million ounces of physical silver demanded for delivery in 9 days. At $84 per ounce, that is $2.8 billion worth of physical silver being pulled out of the system in just over 1 week. Let me say that again because I need it to sink in. $2.8 billion, not paper contracts, not futures bets, not options plays. Physical metal, real silver, being demanded for delivery, being taken out of COMEX vaults, being moved into the hands of the stoppers. And who are the stoppers? Bank of America, JP Morgan, Wells Fargo, Morgan Stanley, BNP Paribas, the biggest names in global finance. These are not retail traders. These are not Reddit investors. These are not silver stackers buying coins at their local dealer. These are trillion-dollar institutions with the best analysts, the best data, and the best information networks in the world. And they are taking physical delivery of silver at $84 every single day. Now here is what makes this even more interesting. While these banks are quietly accumulating physical silver through the delivery process, the paper price of silver is being capped at $89 to $90. Look at the chart. Silver tried to break above $90 today. It got smacked down. Silver tried yesterday. Smacked down. The day before. Smacked down. There are massive short positions sitting at $89 to $90. And every time silver approaches that level, selling hits like a truck. One candle. $89 to $87. Straight down. No hesitation. That is not organic selling. That is coordinated suppression. Someone does not want silver above $90, and they have enough capital, enough contracts, and enough determination to defend that level with everything they have. But here's the part that nobody else is connecting. The same institutions that are shorting silver at $90 on paper are buying silver at $84 through physical delivery. Read that again. Shorting the paper, buying the physical. Why would they do that? Because they know something. They know that the paper price and the physical market are two different things. They know that you can suppress the paper price with short contracts all day long. But eventually, the physical reality catches up. They know that when 33 million ounces of silver leave the vaults in 9 days, and another 30 million leave next week, and another 30 million the week after that, at some point there is no more physical silver left to deliver. And when the physical runs out, the paper shorts are exposed, the game ends, the price explodes, and whoever accumulated the physical at $84 while the price was being capped makes an absolute fortune. That is the game JP Morgan and Bank of America are playing right now. And the COMEX delivery data proves it, but it gets deeper because the delivery data is not just showing WHO is buying, it is showing you the pace at which they are buying. And the pace is accelerating. At 33.4 million ounces in 9 days, March is on track to exceed 40 million ounces or more in total deliveries. That would make March 2026 one of the highest physical delivery months in COMEX history. And here is the thing about high delivery months. They do not happen by accident. When multiple major banks coordinate to take delivery of 40 plus million ounces in a single month, that is a strategy. That is a plan. That is preparation for something. And the fact that this massive accumulation is happening while the paper price is being suppressed tells you everything you need to know about what comes next. Let me show you exactly what the COMEX delivery data reveals. And I mean exactly. Names, numbers, dates, contracts, because this is where the story gets undeniable. Pull up the delivery notice from March 9th, 2026, 65 contracts issued, 65 contracts stopped, settlement price, $84.31 per ounce. Delivery date, March 11th. Now look at the names. On the issuing side, the banks selling silver into the delivery. Macquarie issued 45 contracts. Deutsche Bank issued 7 contracts. StoneX issued 8 contracts. ADM issued 5 contracts. These are the shorts, the sellers, the ones who are letting go of their silver. Now look at the stopping side. The banks buying silver through delivery. Bank of America stopped 26 contracts. BNP Paribas stopped 15 contracts. Wells Fargo stopped 9 contracts. JP Morgan stopped 8 contracts. Morgan Stanley stopped 4 contracts. 26 contracts for Bank of America. At 5,000 ounces per contract, that is 130,000 ounces of physical silver in one day. At $84 per ounce, that is nearly $11 million worth of physical silver acquired in a single delivery notice. And that is just one day. Now let me show you the pattern. March 8th, delivery notice. Bank of America, 31 contracts stopped. JP Morgan, 12 contracts stopped. Wells Fargo, 8 contracts stopped. March 7th, Bank of America, 28 contracts stopped. Morgan Stanley, 9 contracts stopped. BNP Paribas, 11 contracts stopped. March 6th. Bank of America, 24 contracts stopped. JP Morgan, 15 contracts stopped. Wells Fargo, 7 contracts stopped. Do you see the pattern? The same banks show up every single day on the stopping side. Bank of America, JP Morgan, Wells Fargo, Morgan Stanley, BNP Paribas. They are not buying once and waiting. They are not making a single trade and sitting back. They are taking delivery every day, consistently, relentlessly, methodically. This is not reactive buying. This is not, oh, silver looks good today, let me grab some. This is a systematic accumulation strategy. The biggest banks in the world have decided they want physical silver, and they are taking it out of the COMEX vaults day after day after day. Now let me put this in perspective with some historical context. In a normal month, total COMEX silver deliveries might be 15 to 20 million ounces. In March 2026, we are already at 33.4 million ounces with 21 days still left in the month. If the current pace continues, March will see deliveries of 70 to 80 million ounces. That would be 4 times the normal monthly average. But here's the really interesting part. The registered silver inventory in COMEX vaults is currently around 35 million ounces. Registered silver is the silver that is actually available for delivery. It is the metal that has been designated by its owner to fulfill futures contracts. 33.4 million ounces have already been demanded for delivery this month. The registered inventory is 35 million ounces. Do the math. We are 9 days into the month, and the delivery demand has already consumed 95% of the available registered inventory. What happens when more delivery notices come in? What happens when the banks want another 20 million ounces next week? What happens when the registered inventory hits 0? I will tell you what happens. Either silver moves from eligible to registered, which means current holders have to give up their metal, or the COMEX defaults on delivery obligations, or the price explodes higher to the point where holders are willing to sell. There are no other options. This is not speculation. This is mathematics. And the banks taking delivery right now understand this math better than anyone. They know the registered inventory is nearly depleted. They know the delivery pace is unsustainable at current prices. They know that something has to give. And they are positioning themselves to be holding the physical metal when it does. Now let me address something important. You might be thinking, if the banks know silver is going higher, why are some of them shorting it at $90? Great question. And the answer reveals how this game really works. The banks are not a monolith. They are not all acting together with the same strategy. Some bank trading desks are running short positions to profit from the daily volatility. Other bank desks are accumulating physical for long-term holdings. Sometimes these are even different desks within the same bank. JP Morgan's futures trading desk might be shorting silver at $90. JP Morgan's physical metals desk might be taking delivery at $84. Both positions make money if you understand how they work together. The shorts at $90 keep the paper price capped. The physical buying at $84 acquires metal at suppressed prices. When the cap eventually breaks, the physical holdings explode in value, more than offsetting any losses on the short positions. It is a sophisticated strategy, and it requires massive capital, massive market access, and the ability to operate on both sides of the market simultaneously. Retail traders cannot do this. Hedge funds cannot do this easily. Only the biggest banks in the world can execute this kind of strategy, and the delivery data shows you they are doing exactly that. Now, before I move on to the technical analysis, I need to tell you about something I am building for this community. Many of you have asked me for daily updates. You want to know what the delivery data shows every morning. You want real-time analysis when headlines hit. You want to be part of a community that understands this market. So I am creating a WhatsApp channel for finance currency, daily updates, breaking news analysis, delivery data breakdowns, chart alerts, completely free. The link will be in the description. Join the channel, get the updates that the mainstream financial media will never give you. Now let me show you what the charts are telling us about where silver goes from here. Pull up the silver 1-hour chart because this is what every silver investor needs to see right now. What you are looking at is a textbook descending triangle formation. The lower highs are getting compressed. Each rally is weaker than the last. The resistance line is descending from the recent highs. But here's the key. The support line is not descending. Silver is making higher lows. 82. Then 84, then 86, then 87. The floor keeps rising. While the resistance at $89 to $90 stays firm, the support beneath the price keeps climbing. What does that tell you? It tells you the buyers are getting more aggressive at lower levels. Every dip is being bought faster than the previous dip. The shorts are defending $90, but they are having to defend it from higher and higher starting points. That is a sign of a resistance level that is about to break. Now look at the 5-minute chart. Same pattern, zoomed in. You can see the descending resistance line from the recent highs converging with the ascending support from the recent lows. Silver is being squeezed into a tighter and tighter range. The triangle is compressing. And based on the rate of convergence, the apex of this triangle hits within the next 48 to 72 hours. That means by Wednesday or Thursday this week, silver has to choose a direction. It cannot stay compressed in this range much longer. The mathematics of the pattern do not allow it. Something breaks, either the resistance at $90 or the support at 86 hours. Let me walk you through both scenarios because I want you prepared for whatever happens. Scenario 1, silver breaks above $90. The shorts defending that level get squeezed. When a short position loses, the trader has two choices: take the loss and close the position, or add to the position and hope the price reverses. If they close the position, they have to buy silver to cover. That buying adds to the already existing bullish momentum. More buying means higher prices. Higher prices mean more shorts getting squeezed. More squeezes mean more buying. It becomes a self-reinforcing loop. In a squeeze scenario with the physical constraints we are seeing, with 33 million ounces already pulled from the vaults, silver does not just go to $91 or $92. Silver gaps. $90 to $95 in a matter of hours, maybe 98, maybe higher. The move would be violent because all the compressed energy from weeks of being capped releases at once. And here's the key technical factor. Above $90, there is no significant resistance until the $100 area. The chart is wide open. There's nothing to stop a run from $90 to $100 except psychology. And if the shorts are covering, psychology says buy, not sell. Scenario 2. Silver breaks below support. The ascending support line is currently around $86 and rising. If silver loses that level with conviction, if it breaks below $86 and stays below, the shorts win the battle. Silver revisits the $80 to $82 area. That would be painful in the short term. No question. But here's what I would tell you about that scenario. Even if silver breaks lower, the fundamentals have not changed. The vaults are still draining. 33 million ounces are still demanded for delivery. The banks are still accumulating physical. The war is still happening. The macro environment is still bullish. A break lower would be temporary. And more importantly, a break lower would be a gift. Because if silver drops to $80 or $82, the banks will use those lower prices to accumulate even more physical. The delivery pace would accelerate, not slow down. and the eventual squeeze would be even more violent because even more physical would be removed from the system at even lower prices. So which scenario do I think is more likely? Look at the evidence. Higher lows, aggressive buying on every dip, $2.8 billion in physical deliveries, major banks accumulating every single day, gold already breaking out above $5,200 and running freely. The weight of evidence points to scenario 1, the breakout, the squeeze, the run to $100 and beyond. But I am not here to tell you what to do. I am here to show you the data and let you make your own decision. Now let me talk about gold, because the gold-silver relationship right now is one of the most important signals in this market. Gold opened at $5,140 today. It pumped over $50 and broke above $5,200. A massive breakout. Gold is running freely. Nobody is capping gold at $5,200. There are no massive short positions defending a specific level in gold the way there are in silver at $90. Gold cleared its resistance. Silver has not. Why does that matter? Because in a normal market, silver follows gold. When gold breaks out, silver follows with a bigger percentage move. That is the historical pattern. That is how the gold-silver relationship works. Gold moves 3%, silver moves 5%. Gold moves 5%, silver moves 8%. The leverage effect. But that is not what happened today. Gold broke out with a $50 candle. Silver sat there, stuck at $89. That disconnect is a major signal. When gold moves and silver does not follow, something is holding silver back. And we know what it is. The massive shorts at $89 to $90. They are fighting the natural market dynamics. They are fighting the gold-silver correlation. They are fighting the physical delivery demand. And eventually, they will lose. Because you cannot fight fundamentals forever. This pattern, gold leading while silver lags, is something I have seen many times in my years covering this market. It always ends the same way. Silver catches up, and when it catches up, it overshoots. The pent-up energy from being held back releases all at once. Silver does not just match gold's move, it exceeds it by multiples. That is what is loading right now at $89 to $90. A spring being compressed by short sellers who are about to become the fuel for the next leg higher. Every short that gets squeezed becomes a buyer, and all that buying pressure that was being held back by the cap releases at once. Now let me show you what is happening in the broader market that makes this setup even more explosive. The broader market context right now is unlike anything I have ever seen. Crude oil pumped to $119 yesterday when the futures opened on the oil depot bombing news. Today, oil crashed all the way back to $81, a $38 move. In crude oil, the most important commodity on earth, that is a 32% swing from high to low. I have been watching energy markets for years. I have never seen a candle that violent. Then a headline dropped about potential ceasefire negotiations. Oil pumped from $81 back to $85 in a single candle, a $400 move in minutes. This is what a war-driven market looks like. One headline moves everything 10% in either direction, and gold and silver are caught in the crossfire. Gold got slammed from $5,200 down to $5,000 on initial comments about the war ending soon. Then it recovered back above $20 when contradictory statements came out. $200 swings in gold, $38 swings in oil, everything flying in every direction. And in the middle of all that chaos, the one thing that is not moving freely is silver above $89. Everything else is exploding up and down. Silver is pinned. That tells you everything you need to know about the level of intervention happening at $90. Now, here's what you need to understand about this environment. The daily price action right now is not about fundamentals. It is about headlines. A single sentence from a world leader can move oil $20. A single statement from a government official can reverse the move. Gold and silver are being whipped around by algorithms that react to keywords. The word Hormuz moves the price $5. The word ceasefire moves it $10. The word escalation reverses everything. These algorithms do not know or care about how much registered silver is in the COMEX vaults. They do not know the delivery data. They do not know that 33 million ounces have been pulled for delivery. They trade keywords, and right now the keywords are changing every 30 minutes. That is why the paper price of silver is meaningless for anyone thinking long term. The paper market is being manipulated by bots trading headlines, but the physical market tells a completely different story, and this is what separates the noise from the signal. While the screen price swings wildly on every headline, while the shorts defend $90 with everything they have, while crude oil does 50% round trips in a single session, the banks are quietly signing delivery notices for physical silver at $84 every single day. Bank of America, JP Morgan, Wells Fargo, Morgan Stanley, they do not care about the daily candle. They do not care about Trump's press conference. They do not care whether oil is at $81 or $119. They care about one thing: getting their hands on physical silver at the lowest price possible before the inevitable repricing happens. And the delivery data shows they are doing exactly that. This is the hidden truth that the headlines will never tell you. The paper price says chaos. The delivery data says accumulation. Those are two very different stories, and I know which one I trust more. The question you need to ask yourself is, why would the most sophisticated financial institutions in the world be systematically accumulating physical silver if they did not believe the price was going significantly higher? These are not dumb money investors. JP Morgan has the best analysts in the world. They have more information than any hedge fund, any retail investor, any government agency. Bank of America manages trillions of dollars. They do not make moves on whims. They do not accumulate assets for no reason. When banks of this size start taking physical delivery every single day, they are not speculating. They are positioning. They are preparing for something. And based on the pace of accumulation, they are preparing for something big. Now I want to address something that I know many of you are feeling: frustration. You watch gold break above $5,200 and run freely. You watch silver get capped at $89 and rejected again and again. You see the headlines creating chaos in both directions, and you start wondering if the bull case is still intact. I get it. I feel it too. Watching silver get rejected at a key level while gold runs is one of the most frustrating experiences in this market. But here's what I want you to remember. Silver always does this. It always lags gold in the early and middle stages of a move. It gets capped, it gets shorted, it gets held back at key resistance levels, and then it breaks. And when it breaks, it does not just catch up to gold. It overshoots gold by multiples. That is how every silver bull market in history has played out. Gold leads, silver lags, silver gets held down, then silver breaks out, then silver goes parabolic. We are in the held down phase right now. The charts prove it. The short positions at $89 to $90 prove it. And the delivery data proves that the smart money is using this phase to accumulate before the breakout. So if you are frustrated, I understand. But do not let that frustration shake you out of a position that the biggest banks in the world are actively building. They are not frustrated. They are patient. They know what is coming. And now, so do you. Here's what I am watching for tomorrow and the rest of this week. The descending triangle on the 1-hour chart is tightening by the hour. The resistance at $89 to $90 and the rising support at $86 to $87 are converging. Based on the rate of convergence, the triangle apex arrives within the next 48 to 72 hours. That means by Wednesday or Thursday this week, silver has to make a decision. It cannot stay compressed in this range much longer. If gold stays above $5,200 and keeps pushing higher, that puts enormous pressure on the shorts at $90. Because as gold rallies, the silver bulls get more aggressive. The buying pressure on silver increases with each dollar gold gains. The shorts have to sell more contracts to hold the cap, but selling more contracts at $90 means their exposure grows. And bigger exposure at a level that is under increasing pressure is a recipe for a violent squeeze. The specific scenario I'm watching for is this: silver breaking above $90 with volume and holding above it for a 4-hour candle close. If that happens, the short covering begins. And short covering in a market where 33 million ounces of physical has already been pulled out through deliveries could send silver to $95 or higher in a matter of hours. That is the power of a squeeze in a physically constrained market. The paper shorts try to buy back, but there is not enough physical supply to match the demand. The price explodes until it finds a level where holders are willing to sell. And right now, with the war headlines and the macro environment, there are not many holders willing to sell. Let me give you some price targets based on the technical analysis. If silver breaks above $90 with conviction, first target, $95. This is the measured move from the triangle pattern, the height of the triangle added to the breakout point. Second target, $98 to $100. This is psychological resistance, the big round number. Expect some hesitation here. Third target, $108 to $110. If silver clears $100, this is where the next major technical resistance sits based on historical price action. On the downside, if silver loses the $86 support. First support, $82 to $84. This is the previous consolidation zone. Expect buying to emerge here. Second support, $77 to $80. This is the recent swing low area. Heavy buying would likely defend this level. I want to be clear, I am not predicting which scenario happens. I am showing you what the data suggests and what the charts indicate. the weight of evidence points higher. But markets can do anything in the short term, especially in a war-driven environment where headlines change every hour. Be prepared for both scenarios. Have a plan for if silver breaks out. Have a plan for if silver breaks down. The worst position is being caught off guard by either move. Now let me give you a rapid summary of everything we have covered because I want these key points burned into your memory. JP Morgan is taking physical delivery of silver at 84s. Bank of America is taking physical delivery of silver at 84s. Wells Fargo is taking physical delivery of silver at $84. Morgan Stanley is taking physical delivery of silver at $84. 33.4 million ounces demanded for delivery in 9 days. $2.8 billion worth of physical silver being accumulated. COMEX registered inventory nearly depleted. Massive shorts defending $89 to $90. Physical buying happening at $84 while paper shorts cap $90. Gold breaking out above $5,200 and running freely. Silver stuck below $90 while gold runs. Disconnection from normal correlation. Oil swinging $38 in a session. Gold swinging $200. Unprecedented volatility. Triangle pattern converging. Apex in 48 to 72 hours. Breakout or breakdown coming this week. The shorts are about to find out what happens when you try to cap a market where the physical metal is leaving the building. This is the setup, this is the data, this is what the biggest banks in the world are doing while everyone else watches headlines. Now I have some asks for you. First, if you got value from this video, hit that subscribe button. I cover the COMEX delivery data, the chart analysis, the macro environment, and the forces that drive gold and silver prices at a level that nobody else does. Every video is packed with data, research, and analysis that takes hours to put together. If you want to understand this market, if you want to see what the banks are actually doing instead of what the headlines say, subscribe to Finance Currency. Second, I asked you at the beginning to drop a comment with the time you are watching and where you are watching from. If you have not done that yet, do it now. I want to see this community. I want to know if there are people watching from London at midnight, from Sydney at 6 a.m., from New York at lunchtime, from Dubai at 3 a.m. Drop that comment. Time and location. I read them all. Third, I mentioned earlier that I am building a WhatsApp channel for this community, daily updates on the delivery data, breaking news analysis when headlines hit, chart alerts when key levels are tested. This is for those of you who do not want to wait for YouTube videos, who want real-time information, who want to be part of a community that understands what is really happening in gold and silver markets. The link to join the WhatsApp channel will be in the description. It is completely free. Just daily value delivered straight to your phone. Join now before the breakout happens so you do not miss the move. Finally, drop a comment and tell me, do you think $90 breaks this week, or do the shorts hold? Do you think the war headlines calm down or get worse? What is your silver price target if $90 breaks? I will pin the best analysis in the comments. I want to see what this community thinks. And share this video with anyone who is confused about why silver is not running with gold. The delivery data showing 33 million ounces of accumulation while the price is capped is information that every silver investor needs to see. Help me reach more people who need this information. This is Finance Currency. JP Morgan and Bank of America are loading silver at $84. 33 million ounces in 9 days. 2.8 billion in physical accumulation. Shorts defending $90 with everything they have. Gold running free above $5,200. Oil swinging 32% in a session. War headlines changing every hour. And through all of that chaos, the biggest banks in the world are quietly, methodically, relentlessly taking delivery of physical silver. The paper price says one thing. The delivery data says another. Follow the metal, not the noise. I will see you in the next video.